Hello everybody, welcome to our newest webinar in which we will discuss how to use the stochastic oscillator. The stochastic oscillator is a momentum indicator that shows us the location of the close relative to the high-low range over a set number of periods. Could say that the stochastic oscillator does not follow price, it doesn't follow volume or anything like that. It follows the speed or momentum of this price. First of all, I want to show you how to set up the indicator. So you will go into your MetaTrader 4 platform, you will click on the insert, you will select indicators, oscillator, and the, where is it? There we go, stochastic oscillator. After you click on it, you will add the indicator with the default settings, and that will be, the levels will be between 80 and 20. Now there are three different ways on how to use the stochastic oscillator. First of all, we can identify overbought and oversold signals. We can find divergences, and the last one is to find bull or bear setups. So I will go each one of the options, each one of the ways to use the indicator one by one. I want to start by how to identify overbought and oversold sell levels. So the oscillator, first of all, ranges from 0 to 100. No matter how fast a currency pair's price advances or declines, the stochastic oscillator will always fluctuate within this range. Now the traditional settings use 80 as an overbought and as an overbought threshold, and 20 as an oversold threshold. Secondly, it is very important to note that the overbought readings are not necessarily bearish, and vice versa. Now, currency pairs can become overbought and remain overbought during a strong uptrend. Therefore, we should identify the bigger trend and trade in the direction of this trend. Something else is to have in mind to look for occasional oversold readings in an uptrend and ignore frequent overbought readings. Similarly, we look for occasional overbought readings in a strong downtrend and ignore frequent oversold signals. I have placed two examples for a buy and a sell. The first one is a very strong bullish signal. Just a small note, when the stochastic will trend below the 20 level, does not necessarily mean it will immediately revert. So we prefer to wait for the stochastic to cross the 20 level and go upwards. In this case, there's a very nice bullish signal of around 320 pips. That's an amazing opportunity for a profit, and vice versa. Now we'll go to the other example. You will see here, as I'm pointing, the indicator, the stochastic, has actually crossed downwards the 80 level. So it, as I told you, it can remain between above or below overbought or oversold. So in this case, again, we wait for a clear crossover, which happened, and of course we have a very nice 400 pip trade here. Now, I would like to go to the next way to use the indicator. I would like to inform you about divergences, which form when a new high or low in price is not confirmed by the stochastic oscillator. Let me be more specific. Let's take the first example. Let's discuss about the bullish divergence. Now, a bullish divergence forms when price records a lower low, but the stochastic oscillator forms a higher low. This shows less downside momentum that could foreshadow a bullish reversal. And I have pointed out the two examples, one on the chart and below on the stochastic oscillator, and obviously there is the confirmation on this particular currency pair and the 350 pip trade. This is on the daily chart, but you can use it at any time frame. Now let's take a look at the bearish divergence, which of course is the opposite, as you can see on the chart. Now, bearish divergence forms when price records a higher high, but the stochastic oscillator forms a lower high. This shows less upside momentum that could foreshadow a bearish reversal. Hence, there we go, a very nice 450 pip trade approximately. So these are two very good examples. You can fast forward, back, or behind, just to take a look, another look later. Let's take a look at a bull setup and a bear setup. What I mean, a bull setup, as I have shown in the example, a bull setup is basically the inverse of a bullish divergence. The currency pair price forms a lower high, but the stochastic oscillator forms a higher high. as you can see in the example here. Now, even though the currency pair's price could not exceed its prior high, the higher high in the stochastic oscillator shows strengthening upside momentum. You can see it on the chart. The next decline, of course, is expected to result in a tradable bottom. So this is all about bull setup. Let's take, of course, again the opposite on a bear setup. I have made also an example here for you guys. So a bear setup occurs when the currency pair forms a higher low, but the stochastic oscillator forms a lower low. Even though the pair held above its prior low, the lower low in the stochastic shows increasing downside momentum. The next advanced is expected to result in an important peak, and again you can see this very nice trade around 400 pips. So this is also a very good opportunity for profits to be made. To sum it up a bit, one more time for you guys, as I told you, there are three ways to look at the stochastic indicator and how to find trading opportunities. The first one is by identifying overbought and oversold, as shown in the examples here. The second way is by finding divergences, bullish or bearish, as we did on the examples. This is the bullish one and the bearish one. And the final is by identifying bull or bear setups. This is the bull setup here and the other example, the bear. I hope this was clear enough for you. You can review this webinar at your own time and pace. Thank you for listening. Thank you for tuning in. I'm going to be in touch soon. Have a nice day. Cheers.